As a business owner, the most profitable move that you can make is to become your own banker. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. For today's life lesson, we're going to be addressing LLCs, loan rangers, lines of business, all things business as it pertains to implementing infinite banking. Now, my own background is I started professionally as a law enforcement officer in the state of North Carolina. And then I taught high school Spanish for some years after that. And then I began my dive into the business world, into working for myself. And I have ever since. And what I would like to do with this life lesson is to be able to reach out and help business owners, whether you are sole proprietor, whether you have your LLC, whether you are in a small business and you've got a team, whether you've got a big business, whatever the case may be, anything that you're doing in business. That's why we've done this series of life lessons where we've talked about legacy and leveraging liabilities and land and all these different things. But well, here we are talking about the LLCs and the lines of business and the Lone Rangers. I know plenty of folks that work for themselves out there. And what I'm saying for everyone is that the most profitable thing that you could do in being in business for yourself is to now be in the business of being your own banker for that business. So let's first remind ourselves, if you've not seen this yet, I remember when I first saw this quote, and I was in the very first year of my own business when I saw this quote from Will Rogers when he said, "The problem in America isn't so much what people don't know, it's what people think they know that just ain't so." And I found that to be true myself. There I was sitting, seeing a presentation on the infinite banking concept when I found lots of things that I thought that I knew about money brought to a new light. And I had to rethink my thinking. Well, what I commonly tell people is that when I was first exposed to this idea of becoming your own banker, when I first saw a presentation and was introduced to the book Becoming Your Own Banker by Nelson Nash, it was like being unplugged from the matrix. It was a red pill moment. It was a renaissance moment. It was an awakening moment for me to see an opportunity that wasn't even on my radar. I wasn't even aware that I could be my own banker. And there I was in business, just trying to do the best for my family, of course. My wife had just given birth to our second son, so we were pursuing careers, growing as a family, building a business. And from that time on, we began to become our own bankers. So I'm here to share some of my best practices and encourage you to consider what it looks like becoming your own banker and why. And let's start with why. Simon Sinek famously says, start with why. Let's start with why. Look right now in your own mind into your business. Let's just consider what some of the more noticeable expenses are. Is that payroll? Is that taxes? Is that your overhead? Is that equipment? I'm going to say that there is a mystery expense that's not recognized, it's not addressed by the average financial entertainer or educator or professional out there, and we're going to get into it. But think of whatever that top expense is for you. And then consider moving forward. You've always done this. You have always done this. I don't know you perhaps, and I don't know your business, but you do. But I know that you've always done one of two things when it came to that expense. You've either paid for it with credit or cash. Maybe both, but those were your two options, credit or cash. Well, let's look at those two conventional options of finance. First, let's look at credit. So using debt, that means that you go negative, you go below zero. So just notice that the starting line is zero. That's so important. We'll return to that. Starting line zero, you go into debt, you borrow money, and typically that cycle repeats itself and it repeats itself. Sometimes we don't even make it back to zero before we begin to deepen that cycle. But either way, there are some aspects of using credit for financing the things that you're going to do in your business. Who controls the terms? Do you even qualify? Are you having to front collateral? You're certainly going to be paying interest, could be substantial interest. You've got to go through the labor and the timeline of applying for this. Can you meet the loan officer next Thursday? And it's certainly, and this is huge, so many things, but certainly a drain on your future cash flows. Did you hear me? I'm saying in your business, if you're using credit, and I'm not saying don't use it, I'm not saying do use it, I'm just pointing this out. If you're promising someone to pay them that principal back plus interest, you are promising away future gains in your business or future profits in your business. You're promising that away right now. Now let's take a little bit deeper look on this real quick. This conventional way of financing business. You receive cash flow, however you receive cash flow. And again, I am wanting to specifically point out here, not income, cash flow, because we all can recognize as business owners that cash flow is very different than your net income. Okay. So the business experiences cash flow. Where do you put that? Typically, when you get that cash flow to your business, it's not income again. Where do you put that? Literally, where do you send that money? Where do you place that money? Big pregnant pause here. I don't want to say it right away. I actually want you to think about what you're doing with your cash flow. You receive money into the business. Where does it go? It goes to a bank. You place it in a bank. Okay. This is a good time to notice that banks are the nicest buildings in the nicest parts of town, in every town, my town, your town, with the best kept grounds, aren't they? Yes. So we put our money in this bank, which is a business. That's important to recognize. So your business is putting capital into someone else's business. Okay. Businesses have owners. Those owners receive profits. So the dividends that a bank earns go to the owners. And then from there, we go out and we finance those things. And again, I've asked you to think of what that one is for you. But again, it doesn't matter whether it's tools, whether it's your overhead, rent, payroll, Uncle Sam's going to get his equipment, etc. We go and we finance things through the bank. What I'm attempting to prompt here is for you to consider, do we have to send that money to a bank, or could we privatize the banking process in our lives, in our businesses? We can. We'll get to that again. Cash. Here's the second way to conventionally finance is to, and this is for my cash is king folks, the method here is to save up and then liquidate when you have the amount that you need for the item that you're going to be purchasing or for whatever it is that you're going to be buying. And then you repeat that cycle over and over and over again. And it is superior to paying interest to third parties. But there, yet again, are considerations for us to notice. There is a time value to capitalizing. Time is one thing we can't get back for sure. And capital has a cost to it. There can be associated risks with where you put this capital. Where are you going to put that cash? Are there risks depending on X, Y, and Z places of where you could put it? Yes, there are. Opportunity cost. This is something not spoken of enough. The fact that your money could be earning money for you. And if it is earning, are you going to be addressing inflation with the earning? Are you going to be able to address taxation? Are you subject to litigation? How easily can you get to it? Lots of things that we should consider about where we would amass capital. But again, let's look a little bit closer at what this process looks like of cash. Financing using cash. You save. I'm saying that word strongly. This is saving when you're using the cash method. This is not investing. Saving and investing are two completely different things. Anytime you're talking about investing, there is inherently an aspect of risk, meaning where you're putting money assumes risk that it could diminish, that it could evaporate. So if we are just consolidating ourselves to saving, actually saving, where should we put those savings? It's a good question to ask. But we do save. We do answer those questions. Am I assuming risk? Can I access? Are there guarantees, taxes, etc.? But notice this, at the end of the day, if you save up, after you answer all those questions about where you should do that saving, you still go down to zero. Remember I said that we were going to return to this. In both of these methods of conventional finance, credit and cash, the end result is that zero baseline. You have to start all over from scratch. Here's my question to you, business owner. What if you didn't have to start over? What if you could experience a constant upward growth trend of your capital for your whole life as a business owner? What if you could experience compounding? Now, compound interest, Einstein is accredited as saying it's the eighth wonder of the world. And he who understands it earns it. And he who doesn't pays it. Now, perhaps you've heard that phrase before. My question is do you know what it actually is? That's not patronizing. I'm just asking. Do you know what it actually is? And if you know what it actually is, are you earning it? And if you're not, why not? And again, notice I'm not talking about investing. I'm simply talking about the financing of your business. Okay? Everything's financed, either with credit or cash. There's that third C of compounding. If you know about it, if you understand it, now might be the time. You might be understanding what it is now or beginning to, and I'm going to have a visual right here, and then you can implement it. So let's consider this mind exercise. Here's a mental exercise for you. Would you, as a business owner, rather have $1 million today? There's some deal, okay, you can close on this business, $1 million today, or a penny that doubles every day for the next 30 days. That's my question to you, business owner. $1 million today, or a penny that doubles every day for the next 30 days. This is a good time for you to hit pause on the video, or I'll just give you the time real quick. Put your answer down in the comment section below. I mean, I'd love to know. And this is a good place to be transparent and honest with yourself. If you've never seen this example before, what's your answer? Put it in the comment section below. Otherwise, let's go through the exercise. $1 million is $1 million. That's really straightforward. Here's the breakdown on a penny. Well, a penny is one day, 2 the next day, 4 the next, 8 the next. You see the process. It's just doubling every day. Well, after a week, you don't have $1. Not $1. After 2 weeks, you don't have $100. You don't even have a Benjamin. Not $100 after 2 weeks. Third week, equally unimpressive. The magic really happens in the last few days. See, on day 28, you crack $1 million. You're actually at 1 point and change, okay? You crack $1 million on day 28. Awesome. After most of a month, you're finally up to, and a little bit beyond, the guy that took $1 million right out of the gate. But there are 2 days left. What does that mean? On the 29th day, you have over $2 million. And then on the 30th day, you have over $5 million. If you took the $1 million, you missed out on $4+ million. That is the power of uninterrupted compound growth. And what I'm saying is when it comes to your finances in your business, remember that expense, whatever it is for you, you can address that with credit, with cash, or compounding. So let's look at a real pragmatic example. Now, you could insert anything here. I'm saying business equipment at the top, but this could be anything that you finance. And again, remember that everything is finance. But let's say there was a piece of equipment that you were going to purchase, and you had been saving, and you had $25,000 to the side. Now, remember, don't get caught up in the numbers. I could be talking about $2,500. I could be talking about $2.5 million. Decimals move left and right. You make this appropriate for you. Every case is different. But for example's sake, notice the principle here. Notice what happens. Let's say you'd saved up $25,000 at your local commercial bank, and I were your banker at that bank. You come into the bank. I hear you whistling through the hall saying you're going to buy that new piece of equipment today. You're going to take your $25,000 out of the commercial bank. And I, as your banker, step up and I say, well, don't do that, John. Don't take your $25,000 out from the bank because we're paying you interest on your bank and you can earn on your money. Let's say I could give you 4%. Now, on this 4%, I'm going to suggest that you could be earning that for your whole life. Let's pretend that it wouldn't be up and down because sometimes banks can pay that amount. Sometimes they can't. Sometimes it's higher. Sometimes it's lower. But let's say that I, as your banker, I really like you. Let's say I could give you 4% guaranteed your whole life. So I say, don't take your $25,000 out. Let the bank give you a loan for $25,000. And again, I like you. I'll only charge you 6%. Okay. And somehow you're going to come out on top. Let's say that I said that as your local banker, I'm saying, leave your $25,000 growing at 4%. The bank will make you a loan for $25,000. We'll only charge you 6%, and you're going to come out on top. Am I telling you the truth? Again, this is another good place to be able to pause. Actually put your answer in the comment section. I'm saying that more for your practice than anything else, for you to really understand something here. Because I know when I saw this the first time, I was thinking, no way, I'm losing 2%. That's a bad deal. Lose 2%? 6 is 2% higher than 4%? That is not a good deal. But you put your answer in the comment section below, please. And now we'll continue on with the exercise. So let's say we were going to do this for a 5-year term, 60 months, 5 years. That's a $483.32 payment. $483.32 over the same time period. I'm not going to change that up. The same 60 months is going to be a total of $28,999. So notice you borrowed $25,000. The total you paid back was $28,999. That's almost $4,000 in interest. $4,000 in interest. And again, could be $40,000, could be $400,000. Notice what happens here though. Did the banker tell you right? Well, over that same time frame of 60 months, 5 years, if you would leave your capital growing uninterrupted interest, compound interest, it would equal $30,525. Well, where did that $1,000+ additional capital come from? From that uninterrupted compound growth. The banker told you right. That is the power of banking. That is the power of uninterrupted compound growth. Now let's go back real quick. Think of that number one expense that you have in your business. The one that, you just hate having to pay that one every month. Whatever it is for you, recognize that while you as a business owner have that on your mind, the payroll or the overhead, whatever it is for you, the average American is in the same boat. You know, those 4 main categories, if we broke them down to what we spend on our automobiles, what we spend on our housing, what we spend on living, our lifestyle, whatever that looks like. And then if we assume that there's savings taking place, which there's typically not. Now, why would I mention that? Why am I speaking about the average American? Well, because that's you. Sure, you have your business, but you also have your household. And these principles permeate into households and businesses and investing, etc. So you could just as easily put something in here instead of where it says autos or housing. You could say overhead. You could say taxes. You could say payroll. You could say equipment or anything else. I want you to notice some things here. The average person is not saving. Do you have savings? Do you have an emergency fund? Do you have a contingent pool of capital that you could access for your business? Now, I am speaking to you still as a business owner. Do you have an emergency fund that you could readily get to? Are you actively saving capital aside somewhere in the event of either an obstacle to your business or an opportunity? Perhaps something comes up to where you could buy out a competitor, or you could move to a better location, or you could upgrade equipment, whatever the case may be. Or also, you might have some economical turmoil that changes the footprint of your space in some way, and you need to weather some storm. Obstacles and opportunities. Remember that savings. It's important, having an emergency fund. But all that to say, too, that if the average American is bleeding out around 34.5% of every dollar that they earn in interest alone. Interest. Remember, credit, cash, compounding, everything's financed. If the average American is bleeding out 34.5 cents of every dollar, what's happening to the average business owner? Well, we know that around 95% of businesses don't make it past the first year. And then over the next 5 years, 95% of those businesses don't make it. Do you think, this is my question, do you think that a business is more or less likely to go out of business if they have a ready access to a compounded pool of capital tax-free? Would that make them more or less likely to go out of business? I'm just saying, perhaps having capital plays a role into being in business. And if the average American's bleeding out 34.5%, what is your business doing? I dare you to calculate this. I dare you to look at last month's statements for yourself. Look at your P&L sheets, your profit and loss sheets. Get to where you can see the amount of interest that you're paying to third parties on your equipment, on your payroll, on your overhead, whatever. Get a dollar amount on that. I dare you to see what that is. I think you'll find it inspiring. I think you'll find it motivating. Now, when it comes to being able to recognize the amount of interest that we're paying out as business owners, and that we could begin to keep that and grow it and compound it, where do we get to this compounding effect? I've already been talking about banking and how profitable banks are. I've already been talking about compounding and how profitable compounding is. Where can you get that compounding? Well, that's my question to you. How would you describe the ideal asset? This asset, this entity that could provide this compounding. We don't just have to stop at compound growth. What other attributes, what other characteristics would you attribute to the ideal financial asset? How would you describe it? And this, when I'm giving this as a live presentation, which I have, I love seeing what folks can come up with. And at the last presentation that I gave on this life lesson to a group of business owners, we heard things like growth. We heard things like tax benefits. We heard things like security. I mean, there are some aspects that people can come up and say, well, yes, I would like it to have this. Well, I'm aware of more than a dozen myself. So the ideal asset, I would purport, has these properties: a significant rate of return, a consistent rate of return. It's conservative or safe. It has liquidity, guarantees, benefits. It's not exposed to market volatility. It provides an income other than capital gains. It's potentially got creditor protection, inflation protection, control. You maintain control over this asset. It's a transferable asset. It's easy to manage, no hidden fees or penalties. It's reputable and private. These are characteristics that I'm aware of in whole life insurance. Yep, I said it. Whole life insurance. A properly structured whole life insurance policy from a mutual company that pays dividends is the ideal financial asset. Now, again, I get it. This is normally the part in the presentation where I put this Will Rogers quote back up and say, remember, the problem isn't so much what we don't know. Now, that may be some of you. Some of you may be seeing some of these things for the first time and you just didn't know what you didn't know. However, many of us know something about banks, or we think we do. And we know some things about whole life insurance. We've heard some things on the radio, on the TV, online. But do we actually know them to be so? I'm just asking for you to investigate for yourself. Here's what I know. We recognize that whole life insurance has a death benefit. It's a life insurance. It's a type of a life insurance that has a guaranteed death benefit. And we are guaranteed to graduate. We are guaranteed to pass. I would point that out real quick. It's not an if scenario. It's a when scenario. We're all going to graduate from this life to the next. I'm happy to talk about that with you too. But in this life lesson, what I'm saying is that a properly structured whole life policy with a mutual company that pays a dividend doesn't just have a death benefit for when you kick the bucket, but it has living benefits. And when you implement this infinite banking concept, as described in R. Nelson Nash's book, Becoming Your Own Banker, these living benefits are infinite. Now, I have given life lessons, and I give life lessons on several different aspects of implementing infinite banking. I've already released my life lesson on land. My boys and I have done a couple of raw land deals. It's been a lot of fun, great educational experience for us. We own policies built this way. We own several. We own multiple policies from multiple companies. We've used our policies for land. We've used our policies for their living benefits to be able to take vacations. We actually just recently got back from one, but we've taken many vacations using our policy as the private family banking system to take those vacations. That's where we've built up our capital. That's where we've accessed capital, taken vacations. That's where we've been financing vacations from. Family lending. My example here is that for family lending, we've done things like weddings within our family, being able to facilitate that for ourselves, finance that for ourselves. Charitable giving. We've been able to use our private family banking system for our charitable giving. We've used policies for living expenses. Now, you as a business owner, again, you could jump in right here and say, well, what are those recurring expenses for you? Here's a picture of me on our property. We pay property taxes. Could you pay some of your taxes from a private banking system? Of course, everything's financed. You could be the banker in that scenario. It's the best way that I know of to be able to build financial independence and autonomy for yourself. Again, we started with one policy and we've built out to a system of half of a dozen policies at this point, covering multiple generations as well. I have released an episode of our life lessons. I began with legacy. Now, I do love this quote from Warren Buffett when he says, someone is sitting in the shade today because someone planted a tree a long time ago. I love that. There are also living benefits that you have in these policies to be able to recapture debts. When my wife and I got started, we first read this book back in 2015. When we got our first policy, we began paying off tens of thousands of dollars of debt that we had in a car note, in credit cards, in student loans. We began paying off our consumer debt, recapturing that money back into our private banking system. And let me give you a quote from R. Nelson Nash himself. He says, and this is, again, differentiating between the death benefit that's always there with these types of policies, but also the living benefits, that our need of finance is much greater than our need of protection. And it's good news that we can achieve both through owning these types of assets, these properly structured whole life policies. So if we go back to this point in our conversation earlier to where we are looking at the cash flow in your business, that money goes to a bank, but it doesn't have to be a commercial bank. You can have your own privatized banking system. You can privately own these ideal assets for the banking function in your life. Remember, just Banking is, financing exists. You can do credit, you can do cash, you can go the compounding route. The way to ideally do that is be the owner of the banking entity. So you have your business. I'm just simply asking you to consider adding one step to what you're already doing. What if you were in the business of financing your business? Wouldn't that put you in control? Wouldn't that have you experiencing the profitability that banks do? And when I talk about adding this one step, that doesn't mean that you have to work any harder. That doesn't mean that you lose control. It doesn't mean that you have to change your cash flows. It doesn't mean that you have to take on any additional risk. It's just adding that one step to what it is you're already doing. You can control and profit from the banking function, the banking business in your business. So consider these questions as a business owner. If you were your own banker, how much more profitable could you be? There's no telling. Again, if you took me up on that challenge to actually look at what you paid in interest dollars just last month, what if you had some of that back? What if you had all of that back? What if you and your business got to keep that? How much more profitable would you be? And if you grew that and scaled that, now think about this. Can you not better position yourself if you're your own banker to outlast and to outpace the competition that's in your space, whatever space you happen to be in? Can't you outlast them and outpace them? If you're your own banker, you don't have to ask permission. You have ready access to compounding capital, tax-free, where you control the access and the repayment. Remember that number one expense, the one that I said made you a little bit angry or maybe a lot angry, to be able to pay every month. What if you could get that expense back in your private banking system? How much more profitable would you be? How happy would that make you? And wouldn't you just rather have the control over financing the things that you want to do in your business than going and asking permission from a third party? What if you could do that for yourself? I'm here to say that you can. I'm here to say that everything is financed and that you can be the banker. And if it's so for businesses, isn't it so for farms? Isn't it so for nonprofits? Isn't it so for the average all-American? And again, that was me and my wife. We got started paying off those debts in 2016 with our first policy after we had read the book, seen a presentation, had consultation calls to be able to get started. And we did so many things. And this is just a snapshot of our first 5 years. We've been doing this for the better part of a decade now. And I'm just getting around to really getting out there to reach business owners. Again, you folks that work for yourselves, you folks that are building an impactful business in your community, you can control and profit from the banking function in your life and in your business. Now, this has been my life lesson on LLCs, lines of business, and Lone Rangers. For a full introductory presentation on infinite banking, make sure to go to my YouTube channel or my website. That's durhamtalents.com to be able to see my introductory presentation to infinite banking. You can also find my calendar link where we could have a free consultation call about what it could look like for you to implement infinite banking into your household, into your business, or into your investing. But this has been a great pleasure for me. Again, you can find me at durhamtalents.com. I hope you have a great day. Remember, you can live and leave a lasting legacy. Take care.